Hey, welcome. We spend so much time, hours, trying to find that perfect entry point for a trade. But what if I told you the real secret to boosting your profits isn't about getting in, it's about knowing exactly when to get out? Today, we are diving deep into something called volatility stops. It's a much, much smarter way to handle your exits. So let's kick things off by talking about a problem that I swear every single trader has felt in their gut. It's that awful, sinking feeling, that moments of, oh, what could have been? You know exactly what I'm talking about, right? You've done all your homework, you find the perfect setup, you set your stop loss because you're being a responsible trader, and then, bam, the price dips just low enough to nick your stop, knock you out of the trade, and then it just reverses and takes off like a rocket without you. It is one of the most maddening things in all of trading.
And here's the tough pill to swallow. You can be 100% right about where the market is headed and still miss the biggest part of the move. Why? Because your exit strategy just isn't as sophisticated as your entry. You're probably using these fixed, static stops that completely ignore the market's natural rhythm. This brings us to a really critical idea: market noise. Just think of it like the normal, random chatter of the market, the day-to-day ups and downs that aren't really part of the main trend. The whole point is, if your stop loss is sitting inside that noise, you're practically guaranteed to get kicked out by accident. The secret is to place your stop just outside of it. So, how in the world do we place our stops outside this noise? Well, this is where volatility stops completely change the game. We're talking about moving away from those rigid percentages or random dollar amounts to a stop loss that's actually intelligent, one that adapts to the market in real time.
Okay, so don't think of a volatility stop as a static line in the sand. Think of it more like a flexible shield that breathes with the market. When things get choppy and volatile, the stop automatically gets wider to give your trade room to move. And when the market calms down, it tightens right back up to protect your profits. And the engine that powers this whole thing is an indicator called the ATR. The average true range, or ATR, is really just a tool that measures that market noise we were just talking about. It looks at how much the price has been moving lately and gives you a solid number for its typical volatility. This is the key ingredient that makes the volatility stop so smart. Now, I know what you're thinking, oh great, math. But honestly, the calculation is way simpler than it looks. Let's just walk through it. First, you just look up the current ATR value on your chart. Easy. Then you pick a multiplier. Let's just use 2 for our example. If you're in a long trade, you take the close price and subtract 2 times the ATR. If you're short, you add it. That's it. That's your new trailing stop level. And here's a perfect real-world example. Say you buy a stock at $100. You look at the ATR indicator and it tells you the stock's noise level is about $2.50. We'll use our multiplier of 2. So 250 times 2 is $5. You subtract that $5 from the price and boom, your initial stop loss is at $95, safely outside that normal daily wiggle. All right, so it's important to know that volatility stop is really more of a category than a single hard and fast rule. There are actually a bunch of different ways to use this concept, and each one has its own pros and cons. So let's take a quick look at some of the main flavors. This table does a great job of laying out the trade-offs. Take the highest high stop, for instance. It's the slowest one on the list. It's built to give a monster trend and an enormous amount of breathing room. The catch? You could end up giving back a huge slice of your open profits before it finally gets hit. Then you've got the classic ATR stop we've been discussing. It's way faster, much more aggressive about protecting your capital. But you do run the risk of getting shaken out of a big trend that's just taking a little breather. It's always this tug of war, right? Between riding the trend and protecting what you've made.
And this, right here, is where the true beauty of volatility stops really shines through. This is absolutely not a one-size-fits-all kind of deal. You can, and you absolutely should, tweak the settings, like the ATR length and that multiplier, to perfectly fit your trading style and whatever market you're trading.
This comparison just makes it so clear. Look at a day trader. Their goal is to get in and out fast, so they're going to use a really short ATR period, maybe 5 or 10 bars, and a small multiplier, like 1.5 or 2. That gives them a super tight stop. But then you have a long-term position trader who wants to ride a trend for months. They'll use a much longer ATR setting, maybe 21 or 30 periods, and a bigger multiplier, like 3 or 3.5. This gives the trade all the room it needs to breathe through those deeper pullbacks. See? It's the same tool, just customized for totally different goals. Okay, I have to give you one really important warning here. Volatility stops are trend-following tools. That's what they're built for.
If the market isn't trending, if it's just chopping sideways with no clear direction, or if it's in a period of just insane, chaotic price swings, these stops can get you whipsawed back and forth. They need a trend to work their magic.
So what's the big takeaway from all this? Well, it's really about a shift in your thinking. It's about graduating from a fixed, kind of arbitrary exit plan to one that's flexible, logical, and actually moves in sync with what the market is doing right now.
So let's just quickly recap the massive benefits here. Volatility stops help you stay in those big winning trades longer because they keep you clear of that random market noise. They actively protect your profits by trailing the price as it moves in your favor. They adapt your risk on the fly as the market heats up or cools down. And maybe the best part? They bring a systematic, less emotional logic to your exits, which helps you fight that classic urge to either sell way too early or hold on for dear life.
And that really leaves us with one final big question you have to ask yourself about your own trading. Because there's always a trade-off. A tighter stop means smaller losses, for sure, but it might cut you out of a legendary trend. A wider stop helps you catch that monster trend, but it means you'll give back a lot more profit when it finally turns. And knowing which of those you're truly aiming for, well, that's the key to everything.